Good everyone, I'm going to be giving my outlook on some of the major pairs, the dollar index, the gold, and Nasdaq. So here we can see the dollar index. This is the 3-month time frame. And we can see that for the past 18 months, we can see that the market has been ranging. So when you see this in the monthly time frame, this is the time to avoid swing trading or position trading. But you can take short-term trades, you can take day trades, you can scalp. You're also avoiding swing trades in the foreign currencies like the Euro USD, British Pound USD, Odd USD, USD card, and so on. So let's go down to the monthly time frame. We can clearly see the market is ranging in the monthly time frame. This is why you don't want to be swing trading. Let's take, for instance, you take a trade from here to this point. Let me measure. Okay, this is a DXY. So let's say you take a trade from here to here. This is about 2 months. It's possible. But what are the chances that you would get this move? Unlikely. But if you are buying when market is moving up this way, there are high chances that if you buy, you'll make profits as price rises higher. Because you can see, I think this is close to about 12 months. And then you have few candles going lower. So the chances of you getting a profitable trade buying is high. Same here. You can see that candles moving higher, that candles moving lower here. So you would want to be selling. And you can see here how market has been trending. So the chances of you getting a profitable trade if you buy is high here because you can see 1, 2, 3, 4, 5, 6, 7, 8, 9. This is the best time to take swing trades. But at this moment, you don't want to be swing trading. You just want to stick to short-term trades and day trades. All right. There's something I would like to explain to us. Before market rallies, you will see a consolidation. So something like this here. You can see how market was quiet here before rallying. You can see something here. Market was getting quiet and then rallied. You can see the same thing here. Market was quiet and then rallied. So after every consolidation, expect a huge move. So you can see here, market has been consolidating for a while. So if market breaks out of this range, we expect a huge move. So let me see if I can get another example for us. You could see that before it moved, market consolidates. So you can see its consolidation, market moved. You can see its consolidation, market moved. And you can see something here, the market moved. So before every huge move, expect to see a consolidation. And that's what we are seeing here. For a long time, market has been consolidating. So let's go down to a weekly time frame. Now we are seeing market action clearly. You can see the market has been in this range for a long time. This range here, this low to this high, and this equilibrium. And then one thing you should understand is that above equilibrium is premium, and then below equilibrium is discount. A market moves from discount to premium, from premium to discount, discount to premium, from premium to discount. So market took this low in a discount and then retraced. One thing you should understand is that market moved from external liquidity to internal liquidity, and then from internal liquidity to external liquidity. Let me explain what I mean. So you can see here, from this point to this point is external liquidity. In between, from this range to this range here, is internal liquidity. Let's say there's a fair value gap here. So market moved from internal to external liquidity to take liquidity below the market, because this high to this low is external liquidity. So you can see our market took out this low here at the external liquidity and then moved back into this range that was created, and then probably there's a fair value gap, other block breaker, whatever. This part here is called the internal liquidity. So let me use the chart to explain to us. So you can see here market rallied downwards, taking out external liquidity. You can see this low here. Expand it for us. You can see this low. Market took out the liquidity, then retraced to take internal liquidity. So this is a fair value gap. After which market rallied downwards to take out external liquidity. So from this high to this low, this is external liquidity, just like the name implies. All right, let's move on. So now we can see market here taking out external liquidity and a market retrace. So if we go down to a lower time frame, we would see this retracement. See this rejection, this wick here. So there was a time market was going down. This candle here represents a wick candle. This is how I spell this. This candle represents 1 wick, not the normal wick we know, not this. I mean WEEK. So the moment market takes out this liquidity, it went back into this range, new formed range that was created. Now, why am I saying all this? Because whenever external liquidity is taken, expect internal liquidity to be taken. So let's take, for instance, let's go for a very good example. Now, once market takes out the liquidity above the market here, this external liquidity from this high to this low, once you see market take out the liquidity, expect market to retrace back into the range to take internal liquidity before continuing. So I hope that is clear. It is very important that we watch for these things. So because now we are seeing that the market has retraced back into this range, we expect market to move lower to take out the liquidity that has been formed here. Because you can see here, this is a low. This low here is lower than this low. So this is liquidity. One thing we should know is that market moves from liquidity, from buy side to sell side, from sell side to buy side. This creates efficiency for the market makers to execute their orders. If you're following the mentorship, you will understand this. So at this point, I have no fear of price going higher again, although there's a fair value gap here. So I have no fear of price returning back to this fair value gap. Why? Because market has already retraced back down into the liquidity. So if we go down to a lower time frame, we see it clearly. So there's no need for price to go back to this fair value gap because price has returned back into the eternal liquidity after taking this low. Now, had it been a black candle was printed here, just like this candle we see here, had it been that this candle here is what it replaces this candle, and then it looks like this, a full candle. I will expect the next candle to print, that is the next week to trade higher, to take the liquidity eternally, then find a trade setup to sell lower. But at this point, since price has already retraced into this range, I don't expect market to return higher. I am bearish starting next week. So we can see here that the point that I'm expecting market to reach is this low. After taking out this low, then I want market to reach this low. I want to see market to reach this low. So I'm bearish dollar. So let's go down to a lower time to see clearly what I've been explaining. All right. So we can see a fair value gap was created in the daily time frame. And then you can see how market took liquidity here. After taking liquidity, let me draw a line so that we can see it clearly. So you can see that market took liquidity here and then retrace. So from external liquidity, so market formed a range, external liquidity, internal liquidity. External liquidity, this low. So internal liquidity, this fair value gap. Then external liquidity, this low. Internal liquidity, this fair value gap. That's how market moves. So we've learned that it helps us determine the bias and direction of the market. So since market has taken this external liquidity here and here, we're expecting market to retrace into internal liquidity, which is this fair value gap. Now, seeing this, we don't expect market to keep going higher. We want to see market run lower to take out liquidity below the market. Okay. Now we can see that market has formed relatively equal lows here, which is a magnet for price. This is liquidity. Market maker seems to aim for these lows. So I am bearish on the dollar I expect for lower prices to take this liquidity here and then to fill in this fair value gap before running for this low and then this low. So this is a 3-month time frame for Euro USD. We can see that Euro USD is finally supporting this 3-month candle, this 3-month order block, and the market has been ranging for quite a while for the past 18 to 19 months. The monthly time frame, we can see the range. We can see market finding support here. Now, remember what I said before. Before you see a huge move like this, market consolidates. So you see market consolidating here. And then the month of August has been bullish. So I'm expecting August to continue to go bullish. Because why? Market is breaking out of a consolidation. And this usually happens all the time. You can see market consolidating here before rallying downwards. You can see consolidation, rally, consolidation, rally. You can see many of them here. Another example here, consolidation for rally. You want to wait for consolidation. Once you start seeing smaller candles printing, expect that the next candle that we're printing, or the next two candles that we printed, will be with speed. All right, so let's go down to weekly time frame. Now, we can see that market has formed a range here. Our market is breaking out of this range. Let me draw out the range so that we see it. This range here. Market has been in this range for quite a while, from 15th of April to 29th of July. There's about 3 months. So you can see market breaking out of this range here that has been formed. Now, one thing I also want to say again is that expect market to find support in the bullish or bearish order block. So you can see something happening here, something that I taught in module 1, element of trade setup. I explained how that you would expect market to find support in the order block found in the equilibrium of a range. So you can see that this range here, from this high to this low, the equilibrium, this is another block. You can see how market is finding support as it breaks out of this range. So expect the order block in the equilibrium to serve as support for price as it breaks out of a range. So we expect market to run higher to take out this high and this high. But let's go down to a daily time frame. Let me explain something. So like I said before, external range liquidity, internal range liquidity, external range liquidity, internal range liquidity. So we can see the market has taken external range liquidity and as well taking the internal range liquidity. So we expect this high to be taken. But if you look closely here, you can see this fair value gap here. Market tapped into it, but not completely. So it's a drawn price. You can see this high as well. Market is drawing towards this high. So I'm bullish Euro USD. So that's one thing you want to also note. If you are bearish dollar, you want to be bullish foreign currencies. If you are bullish dollar, you want to be bearish foreign currencies. So Euro USD is a foreign currency, one of the major currencies. I'm bullish Euro USD and bearish dollar. I want to see that inverse correlation between these two pairs. If I see those inverse correlation, it makes my analysis very, very strong. So let's go to the British pounds. This is the British USD. Same thing is happening here. We can see market finding support in this 3-month order block. One thing you should know is that you want to do your analysis from higher time frame. Highest time frame gives you a stronger bias. This is where the big banks trade. Now we can see how market retrace after finding support in this bullish order block. Market retrace down to close this fair value gap before rallying upwards. So I'm expecting this high to be taken and then this high. So I'm bullish British pound USD. So you can see here the internal range has been taken. So expect external range liquidity to be taken. Market is finding support in this bullish order block and this fair value gap. Now, something I would like to say for the Euro USD, I want to see this candle here hold price. This is a bullish order block. I want to see it hold price come Monday. I don't want to see Monday go below this candle here. I want to see price keep going higher. So if price gets to this point, I will be buying with my stop here because order flow is bullish. You can see how price came down here to fill this fair value gap, rallied upwards, retraced to fill this fair value gap, rallied upwards, retraced to fill this fair value gap, finding support in this consecutively down close candles. This is a bullish order block. The last consecutively down close candle before an up move forms a bullish order block. And what makes it very strong is this fair value gap that we can see here. So it increases the chances of this bullish order block holding price. So we can see that institutional order flow is bullish. So I don't want to see this order block to be broken. As soon as market begins to print next week, come Monday, Tuesday, I want to see this high to be taken. And I want to see this black candle hold price. And then same for British pounds, going down to the daily time frame. I want to see this down candle here hold price before this high is being taken, and then subsequently this high. I don't want to see the candles to print next week to go lower than this order block. Now let's move to gold. This is the gold. Gold is at its all-time high. Gold has been rallying for quite a while. So if I'm bearish dollar and I want to be bullish gold, gold is one of the fastest ways to know the bias for dollar. So if gold is going higher, then dollar should be going lower. So we can see the monthly time frame. There was little consolidation here. And I explained before that once you see consolidation like this, anticipates market movements. So we can see the consolidation clearly here. You can see how market consolidated for quite a while. And then market broke out of a range, this range from this high to this, from this high to this low. You can see the market was ranging for quite a while from here, this low to this high. Market formed the range. Let's go down to delete from it to see it clearly. So you can see this range here. Market broke out on the 16th of July, retraced before continuing the rally. Now remember what I said before, if you draw your fib at equilibrium, the order block you find there is very, very important. You can see how market is finding support in this bullish order block. Now, what confirms this order block? Another block is not confirmed until the high is broken for a bullish order block. And if it is for a bearish order block, you want to see the low being taken. That's what confirms it to be another block. So you can see that the high was taken with this candle here, I think here. So you can see how price retraced down into this other block for rallying to break out this high. This is the range. Market is also retraced to reclaim this other block for rally. Now we are at this point. Market has created consecutively lows here. Now I don't want to see market break below this down candle here. So this candle here is a bullish order block. I don't want to see price calm down and take this low. No, I want to see price find support here. If price gets down to this point, I will likely be buying. Hypothetically, if price comes down to this point, I will likely be buying with my stops here because order flow is bullish. You can see how market found support in this bullish order block here, and the market rallied, taking out this high above the market, then retraced to find support in this bullish order block here, then rallied. You can see market finding support where in this bullish order block here before rallying. So this consecutively lows, I want to see price find support here to continue rallying. Now, don't be deceived to think that market has been rallying in the gold market, so it's time to sell. Never call highs. Market will continue to rally and rally, even though it has rallied this high. Never you think that because it has rallied for a long time, it is time to sell. That's the trap that many traders find themselves in. You end up losing trades if you think that market wants to go down. You don't trade like that. You don't analyze the market like that. You don't look at the market and see it has been going up too long or it has been going down too long. So it's time to do the reverse. You don't call the highs and low. You are safer to follow the trend. Now it is trending. You want to be buying. Now, what will make me go bearish on gold? I'm going to the weekly time frame. If I see these lows being taken, then I'll become bearish on gold. I don't want to see these lows being taken. This lows here, I don't want to see it being taken. our market to continue going higher. To Nasdaq as well has been rallying upwards. So if dollar is bearish, Nasdaq, every other foreign currencies and stocks should be rallying higher. So this is the 3-month time frame. Let's go down to the monthly time frame. And we can see market finding support in this bullish order block, the month of August. So I expect the month of August to continue going bullish. And we can also see a weekly order block here. Market found support for rallying. Now, what made this order block very, very strong and increases the probability of price finding support here? Two things. We can see the market ran a low here. This is a low. And here is a fair value gap. Let me increase it so that we see it. Now we can see that there's a fair value gap here. And the market took out a low here, finding support in this bullish order block. So once you see these two things, it increases the chances that market will find support in the order block. Let's go down to the daily time frame. Well, at this point here, I expect market to find support in this breaker block here. This is a breaker block. Market took out the liquidity below this market before rallying upward. So it has taken out the high. Has it taken out the high? It hasn't taken it out yet. All right. If it takes out this high, I expect market to find support in this breaker block. I don't want to see market rolling down. No. Or to come to this fair value gap. There's no need. This breaker here should find a support because we can see there's a fair value gap here already. So I will expect market to go to fill this fair value gap or a rally upwards for this fair value gap here and then take out liquidity above this high. So please, if you enjoyed this, I would like that. So please, if you enjoyed this, I would like that you press the like button. And then if you want to see more of these, you subscribe to this channel and let me know my faults and let me know what you also learned in the comment section. So thank you very much. And as always, I wish you good luck, good trading.